Good afternoon and welcome to the RAMSDENS Holdings PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Peter Kenyon, CEO, Martin Glyburn, CFO. Good afternoon.
Afternoon. Thank you. Reiterate that welcome. So for those that don't know RAMSDENS, what I'll do is quickly run through what we actually do. So we have foreign currency exchange. 99 point something of our income is selling holiday money to travelers. So if you're going on holiday to Benidorm or Dubai, we will sell you euros or dirhams for that holiday and buy them off you if you come back with any. So that's foreign currency. Pawnbroking is a small sum, short-term loan. We will lend from £10 to unlimited, really, if you've got the asset that we can lend against it. So our highest loan currently is about £100,000 against a very nice watch. We serve all sections of community for all different purposes. But we'll come back to pawnbroking on an outlook. Purchase of precious metals is really if we buy unwanted gold from a customer that we do not think is retailable and we melt it down for its intrinsic value, that is where it goes, if you like, in our accounting lines. Then you have jewellery retailing. So you can see to the right hand side of the screen, there's a picture there of our Eldon Square Newcastle store. It looks like a retailer where we retail new jewellery that we bought from wholesalers. Premium watches that we might have bought from wholesalers or the public, ex-pledge items, if you like, that's the jewellery retailing offering that we've got. So new and second hand and premium watches. And then we do a couple of other services. We offer Western Union transfers and we offer check cashing. Good, reliable, repeat business, but not services that we really push. We don't do high-cost short-term credit, so we've not been affected by the FCA's crackdown into that market. In terms of where we are now, basically we would say it's an excellent recovery from the pandemic. We thought we would get through this. We knew we had a strong balance sheet. We knew we had a diversified model and income streams would come back at different times. So we were confident of the future. We didn't have to borrow to get through all the, if you like, unrest of COVID or the impact of COVID. And we returned to profitability. So profitability is 8.3 million. Our net assets are just shy of 42 million. We've got cash on the balance sheet and we're recommending a final dividend of 6.3, making 9p for the year, which is our highest ever dividend. Bottom left of the screen is really our journey from AIM. So you can sort of see that we were making progress through to 2020. We've got this hiatus and drop, which most companies have, but it's still profitable. And then obviously we'll bounce back now in FY22. We put a few notes on our current trading. So we've had a good quarter for retail, where our gross profit is up 15% year on year. We've had a steady quarter really for foreign currency. So we're about 70% last year and through the summer, and we're about 70% of volumes into the first quarter of this financial year. April is probably the first real event that'll test where will FX get to in the summer. But you've got positive statements coming out of Jet2, EasyJet, Chewy on holiday bookings for this summer. Pawnbroking loan book has continued to grow. It's now at 9.1 million. That's driven off people's need for short-term lending and the fact that there's very little supply. If you want to borrow 100 or 200 pounds, where do you go to now with the demise of home collected credit or payday lending? Moving on to precious metals, the weight that we buy is, if you like, in line with our long run averages and in line with our expectation. Following the year end, we've opened a store in Bootle, near Liverpool. We've opened in Basildon and Bradford pre-Christmas, and we've opened Croydon just this week. So that's 4 stores taking us to 158, and I'll come back to, if you like, our plans for new stores later. Throughout the deck, you'll see that we've shared a column which is the unaudited results for the 12 months to March 20. That's really, if you like, giving you a pre-COVID level of performance. You've got FY21, which is obviously heavily impacted by the COVID, and FY22, where you've got the first half of the year where we're more coming out of it, and the second half of the year, which has been more normalised. And Martin will run through some of the financials.
Thanks, Peter. As Peter says, FY21, the last period, was significantly impacted by COVID, and therefore really comparison to the 12 months to March 20 is actually a better yardstick really for how we've been doing. So revenue in FY22, 66.1 million. That's 63% up, but actually if you look at the 12 months to 20, it's 11% up. So the various segments have been recovering during the period at different rates, but we do now have revenue ahead of where we were before the pandemic. The gross profit growth is only 3%. That's a reflection of currency coming back a bit slower, which is a high margin product, and things like retail growing much faster, which is obviously a cost of sale of that product is much higher. Administrative expenses in the business has grown significantly in the year, but actually last year's figure has some benefit from furlough. So we had 1.5 million of furlough grants, which netted out of the previous year's admin expenses. So again, if you go back to pre-pandemic, the admin expenses are only 4% higher. And that's a mix really. So where we've seen pressure, inflationary pressure, really is into the staff cost. We've given a strong pay review in the prior year of around 8%, and we've just given another pay review on average of about 8% for the current period. So we've seen an increase in staff costs. The rest of the costs of the business are really well established and controlled. Rental costs, for instance, are actually very consistent. If anything, we make a small saving on some lease renewals. So what you see then is from that growth, that recovery of the gross profit back through the P&L, you see the strong return of profitability. So profit now 8.3 million, which is actually ahead of the underlying profit for March 20. If you remember, in March 20, we explained we made a one-off sale of some old stock, which actually generated 750,000 of profit in that year. So therefore, as the segments have recovered, the profitability has really returned quite quickly. If we look at page 7, then we actually drill into a little more detail. So if we look at foreign currency first, as we said at the interims, foreign currency at the start of this period was really still quite small in terms of its recovery, so 30% of pre-pandemic volume. As we've moved through into the new year and into post-Easter, that stepped up to around 70%, which has been really maintained through the summer months. And that's through still a lot of disruption through airports and travel. And therefore, we're very confident, there'll be further recovery in that number. If you look at our Q1 trading, the 70% is sort of stuck in terms of the Q1 update. But currency, again, we mentioned at the interim, the market for currency has widened its pricing. So we were always very, very price competitive. We're still very competitive on price, but we've been able to earn a little bit more on each transaction. And therefore, whilst volumes are still not back to pre-pandemic levels, that you can see the gross profit here has recovered faster than the volume, if you like. So there's 12.7 million of gross profit from foreign currency in the year, and it was 13.1 pre-pandemic. So very close to full recovery in terms of commission. Pawnbroking, as Peter said, the loan book is in a very strong position. Pre-pandemic, it was around 7.7 million. What we've seen is obviously that the loan book grow, but that was been during the period, and therefore there's a lag on the income that generates. So gross profit for the 12 months, 7.5 million. That's still quite a way below the pre-pandemic gross profit of 9 million. But as that loan book now is there for the full year, you'd expect to see the profitability rebound into the current year. As Peter said, with pawnbroking, there's a continued demand post period end, and the loan book has increased again to 9.1 million. at the end of Q1. Jewelry retail has been a significant step forward for the business. You've seen that over the number of years. If you look at revenue here, 27.1 million, and that's more than double it was pre-pandemic at 12.6. So we've seen significant progress over the last 2 years. And gross profit running a little bit slower. So this is the mix of what we've been selling. So premium watches, for instance, are lower margin but higher ticket. And therefore the mix of the margin is reducing, but that's not due to pressure on the margin. It's more to do with the mix of what we've been selling. So as a business, we're probably now around about a third of our stock is premium watches, a third of our retail is pre-owned jewelry, and a third is new wholesale jewelry as well. So that's been a real success for us, and we've invested very heavily into this segment, whilst the pandemic has impacted the other segments more significantly. So what we've seen is 7.2 million of new stock go into the network in the last 12 months. And we've actually also relocated some stores into better locations for retail, and that's part of that investment as well. The website forms part of this segment, and the website growth, again, has been very, very strong for jewelry retail. Purchase of precious metals. So this is buying and selling gold. This started the period in October 21, a little bit subdued. The footfall on the high street was lower, and the Omicron variant sort of saw that through into the new year. Volumes, though, in 2022 being very consistent and back to more long-run averages, and therefore H2 has been very strong. And we've seen that continue into Q1 in the current financial year as well. As Peter said, the other services are very, very mature services, which, slight growth in Western Union, a slight fall back into check cashing as a quite a mature service, but very good, strong income, which supports the profitability of the business. Jumping forward onto the cash flow statement, the business has been significantly cash generative, but we've reinvested a lot of that cash this year into growing the retail segment. So as I just mentioned, 7.2 million of stock to drive that growth in the revenue for retail. We've also seen a recovery in the loan book. So the trade and other receivables cash, 2.6 million. That's that recovery in lending and the interest growth as well in the book as the lending has recovered. But still strong net cash flow from operating activities. But going forward, you'd expect to see a much more lower level of working capital required to continue that growth, given the one-off step forward in inventory in the 12 months. We did purchase a business as well in the last 12 months. That was a business in Boscombe, an independent jeweler and pawnbroker. We paid 0.9 million for that, and there's around about 400,000 of stock that we acquired as part of that business as well. We restarted the dividend following COVID, so you can see there in the cash flow 1.2 million paid in the period, and we've declared a record dividend for the year in terms of from being on the market in 2017. The full year dividend now 9p. This is a 43% payout, and is aligned to our strategy of roughly half of our profit, if you like, paid out as reward for dividends, and the other half reinvested for growth. We see the tax rate increasing over the next 2 years. We'll actually increase that payout percentage and still allow us to grow the dividend into the future. See, the group always looks at the opportunity in terms of dividend payouts and the cash required for growth. Jumping forward to the balance sheet. So the business has always had a very, very strong balance sheet. COVID obviously slowed down the progression, the growth of the business, but actually didn't damage the balance sheet in any shape or form. We didn't have to take, for instance, any C-bills loans. We just obviously had to pause some of that growth activity, which has been restarted in earnest. So what you see is actually that the inventory is the big shift in the balance sheet, which we've mentioned. The trade and other receivables is the pawnbroking lending, which is asset backed and significantly, very, very strong asset class. And we've got a lot of cash in the business. Now, the cash in the balance sheet does include the currency in the tills. It's around about 10 million as at September 22. So therefore, that's not free cash in the sense that we can, for instance, I know one of the questions was asking around, do we purchase our own shares? But what we do in terms of the currency, it's around about 4 to 5 million that we require to run the currency business in the winter. It's around about 10 million in the summer. And therefore we draw the difference through the summer months via our RCF. So that's why you'll see that we have 6.5 million of RCF drawn at the year end, just supporting that increased currency in the currency season of September. So very strong balance sheet, as Peter says, nearly 42 million, and really well positioned to continue the growth.
Thanks, Martin. In terms of our growth strategy going forward, there are no plans to change what we're already doing. We feel what we're already doing is working, and so it's how we incrementally grow from here. We've got it in 5 focused areas, so going through those in turn. If we look at the core estate to start with, it really is taking the income streams and say, how do we improve? So how do we improve the foreign currency? How do we manage the margin very closely to maximize that across both sales and purchases? How do we stay in touch with our customer base so that we can get them to come back and make sure that they get their euros this year from us and next year from us, etc. And how do we slowly enhance our market share, or quickly enhance our market share, that the people spend in a particular town on foreign currency? How do we garner that to be as much as we possibly can? And then with the launch of a new multi-currency card later in 2023, how do we get part of that spend whilst they're abroad, when the customer might use their debit card from their main bank? So we've got activities, and it's all about the conversation that we have with our customers. One of the things in the business and the operational challenges that we have had, if you like, post-COVID, we're not immune, despite some of the excellent feedback we get from our staff. We're not immune from the resourcing issues where people have made lifestyle choices to work from home, seek a different career within NHS or whatever that might be. And we've got a raft of new staff. Now, pre-COVID, the number of staff that we had that had less than 1 year's experience was about 14% of the workforce in store. That's actually now about 30% of the workforce in store. At a senior level, we've got very good retention of the staff. So it's really, if you like, in the stores where we've lost a bit of experience. But the systems are very good. The induction training is very good, which is why we've delivered the results that we have. What we need to do is work with the inexperienced staff, make sure that they can have better foreign currency conversations so that we can cross-sell our other services. If you look at retail, staff training and the knowledge of our stock and the knowledge of jewellery helps our jewellery performance. And that's been a big effort over recent years. And obviously with new staff, we have to go again with that. So we have that investment in our staff development. The displays have improved immeasurably over recent years. The appeal to a wide variety of customers, the diamonds, the watches, the silver jewelry as well. The whole stock inventory is working for us. Moving into pawnbroking, again, how do we give that experience to our staff so that they know when they're lending against something, what can we sell it for? And if you know that it's in perfect condition, you can sell it quickly. Or you've got a customer that is emotively attached to that jewelry, you can lend a little bit more. And be cautious if the jewelry needs to be repaired, etc., and rely on the intrinsic value. So we've got areas that we can progress here, and how do we grow the awareness of our gold buying activities amongst our customer base. So those are also like self-help, self-improvement. Relocations and refurbishments. We've got a nice picture of our Llanelli store that relocated late in the year. I was speaking to Caroline, the manager, just before Christmas, because it's December, retail was very good. And she said, customers are popping in saying, I didn't know you were still here. as the crow flies, this store has moved about 150 yards, but it's moved inside the shopping centre. So we've moved some stores. We've got more stores to move, a couple of stores to refurbish and give them improved jewellery windows because we've got the space to do that. And in the appendices within the lease, you can see that we've got a flexible lease portfolio. So as leases mature, or if a town moves, we can relocate a store, and we're not frightened to do that. So that's driving growth from what we're already doing. Moving on, we have what we would determine as a repeatable model. So why don't we expand the store estate? Our progress in FY22 is a little bit slower than we wanted, but that's actually resulted in a fast start into FY23. So following the year end, I mentioned earlier, we've opened in Bootle, Basildon, Croydon, and a second store in Bradford. We've got Maidstone currently going through a shop fit. I have 4 of the stores progressing through legals, and we've got 2 stores with new heads of terms recently agreed with lawyers to be instructed. So we've got a good pipeline already ready for FY23 and the start of FY24. But the intention is to open 12 stores in this financial year, 10 stores in the next financial year, and 10 stores in the year to 25. Now we will go quicker than that if we're making great progress, and obviously we can go slower than that if things economically become tough. But that's where we're setting out our expansion plans at the moment. In terms of geographic spread of that, we've recently had a rejig of our areas, if you like, the operational areas within the business, created capacity within 3 or 4 of the area managers so they can take 2 or 3 stores across the Yorkshire and the Northwest, and obviously especially in the south and southeast. So we've got good growth to ripple out from where we are now. Moving on, because the store estate is only part of our expansion plans, we want to get better online because that gives us a national appeal as quick as we can. We've talked a lot about our growth of jewellery retailing over recent years, and there's a graph top right hand corner which is obviously very pretty and very successful. Our retail offering online is still very low, so we still have a long way to go, but we are improving. Those results have been delivered with an old website platform. A new website platform has been integrated and launched in October, and we know that the customer search facilities post-launch is far slicker for the customer, so the customer gets a better journey to find what they're looking for. But also the gubbins of the website and the SEO and all that mystique has been simplified so that we should improve our Google rankings. We should be able to get better pay-per-click and affiliate returns, and we've certainly seen that in Q1. Moving to our other income streams, everything has been dumped onto RAMSDENS for cash, which is not really, it's an informational site that you can do other things on, but it's not optimized. It's not optimized to acquire customers. So one of the deliverables for the first half of the calendar year calendar year 2023 is to have new websites, soulless websites, focusing on foreign currency, pawnbroking, gold buying, and using, the domain authority of RAMSDENS for cash as a pathway to these individual sites, a bit like the jewellery retailing site, and hopefully we can expand those services as an online service or supporting the branch estate with that website appeal. The last growth strategy that we have is often called something will come up, which is really the consolidation opportunities that we get. We've got a picture of Payne Pawnbrokers and Jewellers out of Boscombe that Martin mentioned that we acquired for 900,000 in February. That acquisition has gone well. Very pleased with that. Very pleased, with the offering that we've got for the customers and the acceptance of the changes, because Nick, who owned the business, worked in the business. So we've developed it. We've got a great manager in Sonia in the store, and want to take it to another level. The high street has changed. I think you'll all agree that there's sometimes less travel agents, there's less jewelers, and that allows us an opportunity to pick up customers and take local market share. We're open-minded whether we can buy more pawnbrokers. We're very much looking at it now at a national footprint. So if it's a good business that we want to buy that gives us the right return on capital over and above just opening a greenfield site and being a little bit more patient, yes, we're happy to buy pawnbrokers. We've looked at currency providers. We're open-minded on that. We're open-minded on jewelers. We have bought jewelers over the years and converted them. We've done that very successfully in North Allerton. So I'm sure we will get opportunities, and like I say, I sum that up with something will crop up. But we make our own luck. We're well networked, and we're obviously got a positive message throughout our industry in terms of we're willing to buy and make it easy for people who may want to sell. We underpin this with our ESG policies, or the old phrase for it, our corporate social responsibility. So, taking it in turn, if we think about the environment, we want to be very good citizens. We're looking at enhanced reporting next year, in part because we have to. But we need to find the right measure so people can see what our green credentials are. But really, good citizens, let's reduce our energy use, let's recycle where we can, and do things right. So, we've replaced plastic with paper, and that's all been integrated, and we're on a journey of improvement. If you think of social, I talked earlier about our staff and great engagement that we have. We've got a great customer feedback program. We have engaged staff that engage with our weekly and monthly newsletters. We have an annual staff feedback survey, and you can see some of the things there. 92% of employees saying that their department or branch is a very happy place to work, and 87% of the employees look forward to coming to work. I think that that's great feedback. And from a customer perspective, our Trustpilot rating is 4.9 out of 5. And that's actually improved over the last 12 months. And customer service is very important to us because we grow our business through customer recommendations. So we're very focused on customer service. We want to be socially aware to charities in our local communities, and we've helped local charities raise over 19,000 in the last financial year, and more will be raised in this financial year. In terms of governance, we like to do things right. We want to see ourselves very much at the white end of any of the regulatory. Want to be, if you like, the leading light to drive, what is good, what is best practice across all of our services, whether that's advertising our foreign currency rates, whether that's how we treat customers through pawnbroking, all of that. We're QCA, a member of the QCA, we adopt their code. We have all the policies that you would expect a business that's listed to have. We do have board effectiveness reviews. We have reviews on diversity. And we've had a board change this year. So I'd like to thank Steve Smith, who came on board as we came onto the market in early 2017. So the 6 years that we've been on the market, Steve has been with us. And he's helped us tremendously with his challenge and his guidance and his wisdom, a lot of the case. But Steve has decided to step down, and we're very fortunate. We had a lot of people apply to fill Steve's boots, and Karen Ningham was a standout candidate with her background in both online activities, with her day job at Expedia, her NED at the Newcastle Building Society, and her background generally in customer service. So I'm sure Karen will add value as we move forward. In summary, we've got through the pandemic well. We've returned to profitability higher than where we were. All of the income streams are working. Foreign currency can only grow if people travel, but we think we're selling that well. We've enhanced market share. We have a strengthened balance sheet. We've got firepower with cash to make an acquisition should we need to. We've got a strong pipeline of further stores. We've got a plan for improving the existing stores. rewarding shareholders with a positive dividend, and really optimistic as we sit here today. We're confident that we can deliver growth. We're confident that we can deliver growth in the dividend, growth in the profitability, growth in the strength of the balance sheet. So we're very optimistic for the future. I don't propose to go through the detailed slides, but obviously if you have read those in advance and you've got a question on them, please, if you like, do what Paul has asked you to do earlier in that, go to the Q&A and ask a question. So if that's the content, I'm very happy to run through the questions.
Great, thank you very much, Peter and Martin. Thank you for the presentation. Ladies and gentlemen, as Peter just said, do please continue to submit your questions. I see quite a few have come through already. But just while the team take a few moments to review those questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Perhaps before going on to some of the live questions, we did have a number of pre-submitted questions that have come through. And if I may, I'll start off with those. The first question reads, will the board give consideration to using some of our cash balance to buy back shares in the company?
We have actually talked about it previously, but it's not on any short-term or medium-term horizon. As Martin said, the £15,000 cash that we had on our balance sheet at the year end, 10 million of it was foreign currency in the tills. You still need sterling in the tills where customers have paid you. So if you like, the spare cash to buy shares back has been invested in stock and is there to grow our loan book and pay for the capex in new stores. So currently no plans to do that.
Fantastic, thank you. Next question we've got here, and I think obviously you've touched on performance, we've gone through the presentation, but if there's anything further to add, how are you performing in the Southeast so far? What's the opportunity in the region?
The opportunity is huge. In terms of the one store that I have got as a representative example of one, Chatham in its 15 months is doing fantastically well. So a baby store for ourselves would lose money in its first year, would make about 20,000 in year 2, and would make like 60,000 in year 3. Now that's, if you like, a model, and then it would grow average and above average store performance. Obviously, we want to better that. What I can say is that Chatham at 15 months old is certainly well ahead of year 2 and on its way to our year 3 numbers. So it's got off to a good start. Basildon had a good December. Croydon is too early to tell. I've only got like 3 days numbers. So we think there's opportunity in the south, but we've got off to a good start.
Fantastic, thank you. Next one we've got here, are you surprised how well retail has done with the cost of living pressures? What's behind this growth?
Okay, self-help. We've invested in it, talked about the staff development, but you look at the windows, some of the relocations, the way that we present the stock, the 7 million that we have put into stock over the last 12 months. The proposition has changed for the customer. We're more it's a more professional looking jeweler store basically, and we're getting the rewards for that. We've had a good Q1, gross profit up 15% in that quarter year on year. We're still very optimistic despite all the economic challenges and the media doom and gloom that we will push retail forward over the forthcoming years, because we've got a proposition that continues to strengthen. So we're optimistic for retail.
Fantastic, thanks, Peter. Again, question here, have you seen any changes in customer trends across your pawnbroking segment, e.g. different types of customers using the service, different amounts borrowed, different types of items pawned?
Okay, I'd have to say no, and the reason for saying no is really historically we've served all walks of life. We've lent across, if like, all portfolio of assets. So, we've lent small lending, 10, 20 quid on a couple of rings, and we've lent, £100,000 on premium watches. We've done that historically. We're doing that now. What I would say is historically we would be 92% repeat customers. We're now about 90% repeat customers. So the new customer levels are up 25%. Would be the change. So more customers are using us as a pawnbrokers, and we think that will continue. I think you've got people who want a small sum of money, have less options to go to, and RAMSDENS will offer a loan. You know, if you want £5,000-10,000, you'll only pay 2% a month, and that's quite a very flexible loan. You pay it back on a daily basis, so that's attractive to people who want help with short-term cash flow, if you like, of a larger sum. So we think we've got a good offering. We've got the skill set to do those higher value loans, and that's something that we want to attract going forward. That might make our yield lower a bit, but it'll grow the loan book, but the overall return will be higher.
Fantastic, thanks, Peter. Next two questions really are talking about the additional opportunities to open more stores, where you're looking to open. I think you covered that off towards the end of the presentation with that rollout strategy. But one piece perhaps just to dwell on, what's happening to high street rents?
Okay, yeah, it's interesting, high streets. I mean, I've just got a new store that will open in the next couple of months, that's in a town, a city that is, the street that we are opening on was sought after. We were in a race to get that unit. Our strong covenant has enabled us to get that rent, and we've paid actually full price for it. In other towns, we're getting 20-30% off the asking rents. In other towns, there's competition because we might have a small store in a small town, and the rent is sub £15,000, and there's competition. The one-man independent business, for whatever business that they're in, it's competitive to want that space, and obviously they might get a bit of business rates relief at the same time. There are obviously some towns that the shopping experience is far too large. There's too many shops for the number of retailers now having an offer on that high street, and it needs to centralise it. So Stockton would be the example. I know that it's held out, across different local governments. Stockton have bought both shopping centres. They relocated people out of one shopping centre to the other. We were part of that relocation. And the retail offering of Stockton is now concentrated in the Wellington Square shopping area and a bit of the high street. And the old shopping centre has been knocked down. So the shopper has a better experience now in Stockton as a result of that. There are other towns that I've walked at. I'll give you an example. Wrexham. Wrexham is a very large town, very large high street with a strong offering at either end and a complete mixture in between. So lots of towns, lots of opportunity. Some rents are coming down, but we want to be where the shoppers go, and we're quite happy to pay a market rent if that's where the shoppers go and are buying things. So that's where we want to be.
I think the other thing just to mention on the rents is that we do have quite a low average rent, and therefore we've generally taken flexibility rather than take rent savings. So where a lease ends, generally we can stay out of lease, protected under the Landlord and Tenant Act, and actually just pay the same rent rather than fix it in for a longer period to get quite a small financial benefit. So you can see in the back of the pack, we have a very short average time to the end of a lease.
Yep.
Great. And the final pre-submitted question we have is, M&A. What opportunities are you really seeing there?
Hey, look, we've had a couple of early conversations with one-man bands within the pawnbroking sector, but we've talked about our optimism for the pawnbroking sector, and market conditions should be favourable through 2023 for pawnbrokers to grow their loan books. You've got a high gold price, you've got demand, you've got a lack of alternative credit for small sums. So the independent pawnbrokers know that as well. So I'm sure when they've had that growth in their loan book, they might ask the question then. So you've got that as that market conditions are favourable, but regulatory creep, the FCA is not making it easier for independents or larger firms. It's more of an administration burden, but it's not as much a cost for us. And independents are usually older retiring jewelers. So we're happy, we're open-minded, we're advertising to buy businesses, but it's not something that we can speed up, because you've got to be conscious that we can buy and we can open a store and build a greenfield site and be very competitive. So it needs to be a mixture of the two.
Fantastic. That concludes the pre-submitted questions. As you can see, we've had quite a few questions come through during the meeting itself. So if I may just ask you just to click on that Q&A tab, and where appropriate to do so, if you could just read out the question for the benefit of everyone online and give your response, that'd be wonderful, and I'll pick up from you at the end.
Okay, thank you. So question 1, what are the main criterion when considering opening a new store? Well, first one is hopefully we'll make money. And I've talked about the location's important. It has to be within a nucleus of retail. It has to have footfall for retail. It has to have footfall for foreign currency. We draw a pie chart of what we expect the income streams to be when we open a store. We often get that wrong, not really wrong, just so like the picture always morphs a little bit when a store opens. We give ourselves a minimum return on capital of 20%. If we can't get to that, then it doesn't fly at all. So we have a trusted, tried methodology, if you like, for assessing a new store. We walk the high streets, we look at the footfall, we look at what people are wearing, we look at the other stores, staff levels, tills, how many desks and chairs you've got in a coffee shop, how busy the coffee shops. We do it the old-fashioned way, as well as, if you like, the demographics and size of a town. So lots go into the assessment before we actually take it forward. What is the medium-term vision, 5 years, for estate size, and what size could the UK ultimately support? Very simply, 5 years, 50 stores, over 200 stores in 5 years' time is a goal that we should deliver. So yeah, that's what I would say. In terms of overall size, the statistic is there are 300 towns with more than 30,000 people in them, and London counts as one. And we have some very successful stores where the town population is 12,000. So yeah, 500-600 stores is easily the possibility. Are you targeting any particular parts of the country for new stores? Northwest, Yorkshire, we've got some gaps. Southeast, we've got a lot of gaps. So that's where we're initially targeting, and lots of opportunity. And we have a good, strong pipeline of towns that we've already researched, that have passed the bar, and it's about finding the right location. What is your expectation for FX expansion, given that the new year to date has not changed? Ian, I wish I had a crystal ball. Easter is the first test. I've mentioned about holiday travel agents and the sales of holidays. They've been very optimistic. They've said very nice things about the level of holidays that they're selling now compared to pre-pandemic, being close to pre-pandemic levels and some over pre-pandemic levels. Who knows? I think, look, it's a crystal ball. I wouldn't want to lead anybody, but I think it'll be north of 70, and a very optimistic view with a couple of pints in my hand might be 120% of where we were pre-pandemic, because you've got to remember that you've had 3 years of disruption to go on holiday. So hopefully everyone, if you like, listening in is going on holiday and get your currency from RAMSDENS, and that'll help. What is the bad debt ratio in pawnbroking? Well, let me not take it as an accounting question, take it out of reality. Unless we make a mistake, we don't get bad debts in pawnbroking. So we should lend up to a level of the intrinsic value, or a percentage of what we think we can sell it for. So the old maxim is lend half of what you think you can sell it for. If you do that, you do it correctly, then you shouldn't have bad debts. But regrettably, staff do make mistakes. So therefore we add the odd ones, but not much in a 9.1 million loan book. How cost effective to the consumer will your multi-currency card for use when abroad versus a bank debit card? We will sell the currency at less than the banks offer offer it. So most banks would charge you 3% or 3% plus a fee. We will do our card at less than that. The card will be provided free to customers. It will have an app. You'll be able to stop the card. You'll be able to switch between currencies, and that will all be competitive. It won't be at Revolut competitive because we're not going to give it away for nothing. You talk about aiming to increase your market share. What segments are you referring to? How do you measure that? And what are your targets? Well, I'm not going to release any targets because that would give you, if you like, a very good indication of where we see future profitability. But in terms of market share, FX, we have a small market share across the UK, probably 3-4%. In certain towns, I'm sure we might have 40% market share. The leader is the post office, but you have to remember their 25% market share is because they've got 11,000 outlets. I would probably suggest that Eurochange are the ones with the most market share, and obviously we aspire to pinch some of their customers by offering great service and better rates. In a jewellery market share, we are still a minnow at 27 million turnover. Can you deliver growth in any environment provided the stores stay open? Yes. Confident of our offer. Think we will grow through 2023 and beyond. If currency travel cards were to become much more popular at the expense of cash, would this be beneficial for or detrimental to Ramsden's profitability? Ramsden's would change and evolve. What I can say at this moment in time is the average transaction value is about £468, and pre-COVID it was about £407 from memory. So the average transaction value that the customer is taking now has increased. I think if the market changes, then some people will move out of the market. We have our other services. That means we can be last man standing if that was the case. So I think we have a positive outlook on the supply of euro notes if you're going to the Eurozone. How do you expect the return on capital employed on stores to be opened in the southeast to compare with the rest of the store portfolio? You know what? That's a great question that I haven't got an exact answer. Like I said, we've got a hurdle. We have a method. We have an expectation of stores to get to. And as I've explained, Chatham is already ahead of that growth curve. But in terms of their ultimate return on capital, I can tell you that when I chat to my chairman, Andy, he does remind me that we're not trying to replicate average with our new stores. We're trying to replicate top third with our new stores. So, on that basis, hopefully the return on capital employed is better with our new stores. What was the cost? Oh, good. This is a Martin question. What was the cost to Ramsdens of light and heat in the year to the 30th September, so FY22? And how much do you expect this to go up by when the current hedges expire in February 24?
That's a good question. I mean, hopefully the market will have softened by then. But if you look at the cost as a business, it's circa 400,000. If you look at what we sign in a new property acts and some of the new stores where that fix doesn't cover those properties, the average is probably 3,000 per store in the existing estate. We've paid as high as 12,000 on a new store. So it could triple, but I wouldn't expect it all to go that high. You expect some of that to fall back by the time you get to 24, at least, not increase and inflate down slightly in real terms. So it's that sort of number in terms of the risk to us, but equally, it's quite a long time out till March 24.
And that risk goes to all of our competitors too. Okay, why do you believe customers choose Ramsdens versus competitors, and who do you regard are your main competitors? Okay, let's go through that in service. If you take pawnbroking, by far the biggest pawnbroker in the UK is H&T. We butt up against H&T probably in a 50 towns, something like that, and more as we both expand our estate, and obviously as they expand their estate, there's a chance that we will compete against each other. But a lot of our stores are in smaller towns. That's not to say that H&T wouldn't open against us, because they've done so across South Wales, but no detriment to our existing store performance. In terms of jewellery, that can be anybody. So the biggest premium watch provider in the UK is Watchfinder, in our opinion. Sales are well over 100 million. We're a minnow compared to them, but fast increasing. Our watch sales have doubled in the last 12 months, and high hopes that we can continue to grow that service with our experience and very good watch offering online and in store. Other jewelers, we've got some of our bread and butter gold product. So Samuel's, Hines, Warren James, actually not Warren James, because they're mainly into the silver or gold-plated jewellery. So, but there's a lot of jewellers out there, and obviously H&T again for second-hand jewellery. In terms of FX, you've got, I said Eurochange, but Eurochange, supermarkets to a lesser degree, travel agents to a lesser degree. Main competitors would be specialist bureaus. Why would the customer come to Ramsdens? Well, we try very, very hard to give the best service, because we know that we have to overcome, if you like, a long-held prejudice against a pawnbroker. So we've worked very hard at the smartness of our store, the attractiveness of the store, the way the staff are presented, the privacy that we give the store, the customer inside, and the absolutely value for money that they get from Ramsdens. That's why it's like we have a growing customer base, and both our general services and our retail services have great feedback on Trustpilot. Has the Bank of England interest rates currently increasing affect the number of stores you target opening? Higher interest charges, etc. on refurbishment. We don't borrow a lot. We borrow through the summer months for our foreign currency deposit. So it's not really a big cost that would affect us significantly. We've not got what's the word I'm looking for? Structural debt within the business. We've got a proper revolving credit facility. So no, it doesn't affect our ability to grow, and it's just a slight increase in the cost, but not significant. You stated that the margins on currency had widened post-pandemic. Do you think they will continue like this or revert to the mean as the number of travellers increase? Hey, look, pockets will have competitive exchange rates. We've opened in Croydon with a very aggressive exchange rate offering for customers, because we're trying to take market share as we open the town. I think you've got an increased cost base. So if I take Eurochange that I talked about as the main competitor, staff will be their biggest cost. That staff cost will have gone up 8-10%, and they've got to recover that somewhere. So I think they will widen margins. I think the post office will widen margins. I just ask customers to make sure they read the rate boards and make sure that they've got transparency in exchange rates, and we will continue to grow our market share. What is the average length of your leases, and what length will you start your new store on? Well, there's a full table of where we are with average length of leases in the back. Typically, if I might enter into a 10-year lease, but I will have flexible breaks throughout that period, just in case we get a store wrong, or if in case a town moves. So we want flexibility in our leases with break clauses, but 5-year lease with a 3-year break, 10-year lease with a rolling break from 3 years we'd always back ourselves with 3 years into a new location. For the new southern stores, do you make any changes to the store offering? No, if you have a look at Basildon, if you have a look at Croydon, they're very much the same. Probably the subtle change, because we're not known in the southeast, is it does say Ramsdens Pawnbrokers above the door. But if you stood outside and looked at that store, you would see that we have a strong jewellery offering. So we're jewellers. You'll see that we've got a rate board which says that we do foreign currency. And if you look inside the store, you will see, if you like, a cross between a jeweller and bank-style tills to give the customer the privacy that we talked about. What steps can you take to ensure watches sold on your site are not stolen? Oh, well, the provenance of a watch and the person who sells a watch to us, we take a lot of effort. We take our money laundering or anti-money laundering responsibilities or prevention of crime. The last thing we want to do is pay for a watch for, let's say, £10,000 and find that it's stolen, hand it over to an insurance company because we can't sell it. So we take a lot of steps to ensure that we don't buy stolen watches. What do you see as your biggest regulatory risk? Ooh, interesting question. From what I don't know what I don't know. From the conversations that I've had as the president of the National Pawnbrokers Association with the FCA, and what my chief exec at the National Pawnbrokers Association tells me, is we have a very strong relationship with the FCA. The FCA understands what pawnbroking has to offer, and understands the simplicity of the product. They know that the customer has very few complaints. So in that respect, I'm not really seeing any changes to the regulatory nature of pawnbroking. We're a money service business, and we have to be very careful, what I've explained there about our anti-money laundering policies. So, like I said earlier, we want to be at the whitest end of the regulatory risk and have great governance. The more regulation, the better, because it'll take some of the chances away from the market. Sorry, excuse me. In the southeast, new area development, what do consumers know about Ramsdens? The personal recommendation won't exist, presumably. Absolutely correct. So that's why we pitch up in high footfall locations, and we use rent as a marketing expense. So we get a number of eyes go in front of our stores, and then obviously we build those personal recommendations as we go. We have supported stores. We've had a TV campaign in December that was national. We do social media, and we actually have done leaflet drops in areas of new stores. So we do support our new stores as well as its high street offering. I noticed that there are 2 Ramsdens stores within a few hundred yards of each other in Glasgow. Is that planned to continue going forward? If that question means are my 2 stores in Glasgow that are 100 yards apart, or about 300, 400 yards apart, going to both stay open? Yes, they serve different sections of the Glasgow community. One is very good for retail, one is very good for FX. Would we have 2 stores in other locations? Yes, I've just done the same in Bradford. Again, it serves 2 different communities, and one of our new stores is also a second store in a town. Excuse me. Many questions regarding retail stores, but what are the largest risks to the FX business? Do you provide FX to businesses? Largest risks to FX business: people don't travel. Do you provide FX to businesses? No, but we do provide FX to business owners. Sorry, excuse me. Okay, my last question: how do you think Chatham customers came to you to such good effect? Any advertising? No, we're in we've done some advertising. We did some leaflet drops. We've got a very good location. We're next to JD Sports, opposite Pandora. So it's a good location in the shopping centre in the town, which is anchored by Sainsbury's. and supported by social media advertising. Growth plans are commendable and exciting. Thank you. How do we fare in staffing, in particular in new areas like the Southeast? Given full employment and you're paying towards the lower end of salaries, maybe not lower end of salaries in the industry. Retail, we actually do pay the real living wage, and that is, if you like, above what people are paying. So, we've done well in attracting staff to our new stores. I think I've got a gap left in Croydon, but Basildon is fully staffed, Chatham is fully staffed, and we have staff for, if you like, our new store in Maidstone. So it hasn't been too much of a trouble in doing that. And, the stores that we have look good, look great. So, we're attracting people when we do that. What explains the increase in wages and salaries from 10 million to 14.9 million when the average number of employees was the same as in the previous year?
I think the averages are probably slightly skewed in that calculation, but certainly there's obviously a peer review, as we mentioned earlier, an 8% peer review, and that's been done twice really in the last 18 months. We've got the number of people has gradually increased through the year. So actually, there's furlough in there as well, I think. So you've got the offset of furlough, which is 1.5 million in the prior year. So I guess we'd have to look in a bit more detail at those two numbers. But certainly, there is inflationary cost into wages, and there is a bit of variable cost in maybe the number of hours people work as the business has sort of recovered back through the current year. So the underlying cost, I think we've given a decent understanding of what the actual the fixed cost inflationary cost is.
And there's obviously, we've rewarded the staff. They've delivered a fantastic set of results, and they've had some bonuses. I think this might be the last question. Re an earlier answer, you are not hedged for energy costs in the new stores. Presumably that sharply affects profitability. Are your comments on Chatham revenue based rather than profitability based? No, my comments on Chatham are absolutely profit based.
I think the only caveat with that is the contribution towards head office costs rather than net profit cost of those stores. But it is after all the operating costs of the store. Not hedged for the energy costs. No, just because there's turmoil in the market. So we've stayed variable with our limited stores that are subject to the variability of energy costs. And we'll review that on an ongoing basis with our energy broker. Yeah, you can't actually fix the cost of the sites you don't have yet, which is why we're in that position. But certainly, hopefully that, market softens in the next year.
Thank you for those questions. We've had, you're welcome, Ian. We have had a lot of very good questions there, and we appreciate that because we like to have that challenge and engagement. We want to give you transparency in our presentation, transparency in our annual report, and we welcome questions. So if you've got any questions, email us at ir@ramsdensplc.com, and I do my best to answer them if I can.
And thank you so much for answering every single question, as Ian said, that's come through. So we appreciate that. And we're just through the hour mark, which is wonderful. And Peter, perhaps just before redirecting the investors to provide you with their feedback, which I know is particularly important to you guys, if there are just a few closing comments before we wrap up.
The briefness is, we got to COVID, we were in a good space running into COVID, positive about our future, positive that we could have a staircase to our profitability. We've had a hiatus. FY22 deliver us back to where we were. We've got a very positive outlook and confident we can deliver going forward. So optimistic and confident is how I would sum how we feel and how we will take the business forward.
That's fantastic. Thank you very much indeed for updating investors today. Can I please ask investors not to close the session? You should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete, and I know greatly valued by the company. On behalf of the management team of RAMSDENS Holdings PLC, we would like to thank you for attending today's presentation. That concludes today's session. Thank you very much, and good evening to you all.
Cheers.